Good morning, ladies and gentlemen. My name is Simon Mills. I'm an associate at the Zien Group, and I would like to welcome you all to today's FS Club webinar, where we're going to be discussing the road to net zero. I'm joined by Nick Robbins, who's Professor in Practice for Sustainable Finance at the world-famous Grantham Institute. As always, the agenda for this webinar is very simple. Following my introduction, Nick is going to make his presentation, and then we'll begin the Q&A discussion. I'm afraid that you're all muted, but you are able to submit your questions to Nick through the chat tool to the right of your screen. Please do chip in at any point of the proceedings, and I'm going to be collating your questions, and I'm going to put them to Nick at the end. Nick is also going to be providing you with contact details so you can continue discussions with him offline. As with all of our FS Club webinars, we're going to be recording this session, and you're going to be able to access Nick's slides and presentation at a later date. Before we move on, I really must thank FS Club members who've opened up our webinar series to the public. With their help since March of last year, we've held well over 200 of these events on topics as diverse as data gravity, money laundering, and employee share schemes. The FS Club is the premier global executive knowledge network for technology and finance, where in happier times, members and their guests can meet over a glass of wine to debate key issues which impact on financial services, technology and society. Very much like a 21st century version of the city's 17th century coffee houses. And so without further ado, I'd like to introduce today's speaker, Nick Robbins, who I first met when I started at the City of London Corporation back in 2000. And he was then the head of Sustainable and Responsible Investment Funds at Henderson Global Investors. Nick very kindly took me under his wing and introduced me to the world of socially responsible investment. Nick soon moved on to become the head of the Climate Change Centre of Excellence at HSBC before being poached by the UN to head up UNEP-FI's inquiry into a sustainable finance system. Nick joined the Grantham Research Institute in February 2018 and recently chaired a report for the Committee on Climate Change entitled The Road to Net Zero Finance, which assesses the UK financial system's ability to deliver a net zero target. Nick, welcome. Please tell us about the road to net zero.
Well, thanks so much, Simon, and it's really good to be with you all from the FS Club. And I saw on that screen of logos some sort of familiar organisations, notably the Casablanca Finance Authority, who where we launched our Finance Centres for Sustainability Alliance a few years ago when I was at the UN, and also Invest Northern Ireland. I work closely with the City of Belfast on green finance at the moment. Before I go into the presentation, I just want to make sure that you're all warmed up and ready to go, because this is about engaging your brains and not just sitting back. So we have actually a poll question for you. So here it is, nice and simple one. Financing net zero is a priority for my organization. You have 4 options. Yes, top priority, it's important, but not top priority. It's not important for us and don't know, or not applicable. So please do make your choice, and we'll give you the feedback. Really just give you a sense of the audience and how you're sitting for this particular issue. So over you go. And the answers, I hope you can all see that. So interesting. So top priority, 44% of you. So maybe this is a bit of self-selection in this group today for Friday. Another 40%, so a very high number. And then not important, 0. So 0 are not important for net zero, and then don't know 16, which is a reasonable number. Simon, I don't know if you have any thoughts on that, but that's a pretty good way to start this discussion, I think.
I'm glad to hear that everybody's engaged or curious.
Great. Okay, so I'm going to change my screen. It will take a little while. So let's do this. Right. Can you see that okay?
That all looks fine from my end.
Brilliant. Thanks so much, Simon. So again, thanks very much for inviting me. Many of you, as you just shown through your poll results, are very engaged already with net zero. And I just wanted to give you particularly some of the findings of the report that I was happy to chair for the Climate Change Committee on the road to net zero finance. So we'll go through that, and then obviously the point is to get your questions. So just in terms of some sort of summary points, if I may. Clearly, as we are thinking about making success in terms of COP26, this big climate summit, we really need to think about aligning the financial system with net zero, so driving emissions down to zero, making it resilient to the shocks of climate change, and also making it inclusive. There is a race to net zero, and we are seeing increasing commitments from leading banks and investors around the world to net zero portfolios. But I think it would be fair to say that this is still not embedded into routine decision making. Indeed, I think there's quite lots of work still to do. In terms of actually how we get capital into the real economy, into the buildings and transport and energy and agricultural systems that we'll need, the report I mentioned estimates that for the UK, extra net zero investment needs to grow fivefold this decade, so quite a substantial increase to about 50 billion by 2030, and then it will peak in 2035. So I think, again, very sort of important, very obvious point, but obviously investment needs to precede impact. And so in terms of capital investment, this decade is really important. Delivering that is not going to be easy. It requires net zero becoming part of system purpose, reform across the financial system in terms of what private capital institutions do, banks, insurers, investors, what financial regulators do, and indeed what public finance do. And then obviously closely linking with what we could call real economy policies, notably carbon pricing, skills, and regional policy. I'm going to talk mostly about UK policies. Hopefully you'll see lots of relevance if you're not in the UK for your countries. But clearly this year we are hoping to get out of COVID, have a global recovery, very clear commitments around a green recovery and linking that to net zero, resilience and the just transition. And really the prize for COP26 is to put in place the architecture to make this happen. So those are some of the key takeaways. Thank you. Right. So just a bit of background. This report, and there's a link at the back of the report, goes into how this all came about. We know that to avoid catastrophic climate change, we need to get economies down to net zero around 2050. The UK was the first to make this commitment back in 2019, and making net zero is a global standard is now a key goal for the summit. The Climate Change Committee is the independent body in the UK which advises government on actually how to achieve that, and they set 5-year carbon budgets. And clearly, to get to net zero finance is going to be important. So they commissioned a special report, and I was happy to chair a working group with participants from Aviva, Federated Hermes, the Green Finance Institute, London Stock Exchange, that's myself, NatWest, Oxford University, and Schroders. So that's the sort of pool of people that came together. Just in terms of the work that we do at LSE, I work a lot with central banks, a lot on net zero, but also on this theme of just transition. How do we deliver climate action which is also seen to be fair and actually has positive social impact? And this is an alliance we launched in November called the Financing Just Transition Alliance, which involves banks, investors, and also a number of sort of regional climate commissions, such as in Leeds and in Belfast and in Edinburgh. So if you want to know more about that, happy to take questions. So where do we stand? Where do we stand in terms of net zero finance? So many of you will know the story. I think Simon went back to the year 2000, but clearly in the last 5 years, we've had a substantial uplift in terms of engagement between the financial sector and climate challenge. Really mainstream recognition about climate risk in terms of stranded assets, the TCFD reporting framework, and quite substantial shareholder activism we're seeing on this. Growing financial markets. We're now over $1 trillion in terms of green bond issuance, outstanding green bond issuance, and also social bonds, particularly in light of COVID, have grown. So this is really a very substantial growing market. Regulatory expectations, central banks and supervisors are now playing a major role, sending signals in terms of the management quality they expect, about micro and macro prudential, and increasingly about monetary policy. And I was just off a call actually this morning with a number of central banks around Europe discussing net zero. Clearly, we're in this terrible crisis with this COVID pandemic, which is obviously not just a health tragedy, but an economic crisis. But what we're seeing clearly is that COVID is actually deepening rather than deflecting action on sustainable finance. It's a live stress test. As the Indians say, it's preponing transition, as we've seen in the oil and gas sector, bringing forward some of the transitions we expected perhaps later this decade, and it's really stressing the social imperative around change. And then policy signals. With Joe Biden coming into office next week, we'll have about 127 countries with nearly 2/3 of global emissions considering or having adopted already net zero targets. So this is quite substantial momentum. Where do we stand in terms of the UK and going down a level, really? We are seeing commitments in terms of asset owners, insurance companies, pension funds, asset managers, and also banks to net zero portfolios. This is often in the context of 2050, but interestingly, some major asset owners are actually making commitments for aligning their portfolios to net zero much earlier. Quite ambitious here. So South Yorkshire Pension Fund 2030, so not many years away, and the British Telecom BT Pension Fund 2035. So I think that's clearly a major phenomenon. We're also seeing quite substantial capital market shifts. Many of you will be familiar with Ørsted, the offshore wind champion, used to be the Danish oil and natural gas company. It moved out of fossils and now, by the end of last year, had a greater market cap than BP. So a major shift in sort of how capital markets see energy sectors. But I think it'd be fair to say that the net zero target is not yet embedded. Still see mispricing across markets. We have market failures. And also potentially sort of climate risk assessment does not necessarily deliver net zero flows. It might tell you what not to invest in, but it doesn't necessarily make sure that we deliver the amount of capital we need in net zero transport or buildings or industry or energy. And so we also need to get serious as a financial sector, financial system. We've seen lots of real innovation. Green bonds have been a fantastic vanguard, but essentially the challenge now is for all finance to be transition finance. So going into the meat of the report, and this was the chart on the right is a chart prepared by the CCC Secretariat, and is really looking at what we need to do in terms of mobilizing the real capital into the economy in the geographic region of the UK to get to net zero by 2050. And I think you'll see that that slope from 2020 up to 2030 and then 2035 is quite steep. And again, I was very struck how front-loaded this investment challenge needs to be. So a 5-fold increase in additional net zero investment to about 50 billion by 2030. So this is a steep uplift that therefore obviously we need to be thinking about recognizing the investment will precede emission cuts and the capital flows peak in 2035. Clearly, after then, what we'll need to do is winding down and displacing remaining non-zero assets. And very interestingly, the CCC did some research for the advisory group, looking actually at the cost of capital. So the numbers there don't include the cost of capital. They just include the sort of core costs of financing. But we know that if policy is strong, it's certain that actually that can reduce policy risk for investors. And we modeled that actually you could reduce the cost of capital for this mobilization from about 17 billion a year, clearly a very substantial sum, to about 3 billion a year. So clearly good policy is very important for capital markets to reduce the cost of this transition. So that's how much money the UK needs. And if you're not in the UK, think of that curve, the shape of that curve for your own country. It'll be fairly similar, maybe a little bit later, but really it's a next decade challenge. Obviously, these are investments. They are designed to yield returns in terms of reduced emissions and therefore avoiding catastrophic climate change, but also generating returns in the rest of the economy and some significant cuts in operating costs. As you can see in this chart below the line, these are all the savings that are made And as you can see, by 2050 or well before 2050, well outpacing the actual operating the capital cost. So we are moving from a operating cost-based economy, lots of resource consumption, lots of energy consumption, to a capex economy. Interestingly, this also shifts the nature of the economy. We have higher investment in the real economy. I was very struck that by 2035 in the UK, GDP could be about 2% higher because resources will be redirected away from importing fossil fuels, no longer needed, to investment in the human, physical, and technological capital of the UK. So for the economy, this is a plus. And then we have these wider co-benefits in terms of health, in terms of resilience, cutting air pollution in particular, and making the economy more resilient to physical shock. So that's the benefit side of the equation. So that's the challenge. The question obviously is how we get there. One of the things we then looked at in this advisory group is actually what stands in the way. I think our view and the view of these experts that we pulled together was that this could be delivered, but we needed to confront some of the real obstacles that exist. We have still market policy and institutional failures, which mean that investors and banks and other institutions just simply can't see the predictable cash flows they need. We don't have enough development capital to actually develop the pipeline. We have a lack of clarity still about the depth and the sequencing of policy from governments. Demand for net zero financial services is very limited, very mixed. I think in the large scale energy sector, it's very well developed and quite sophisticated. I think in the household sector for green mortgages, it's pretty non-existent. It's quite marginal. We're going to need potentially new financing mechanisms to enable this all to happen, to connect the opportunities and capital pools, particularly, and we might want to come back to this, to think about how defined contribution pension funds can contribute to this, and particularly take on some of these illiquid assets. A lot of focus clearly on data, disclosures improving, but it's still incomplete. And importantly, a really interesting signal that actually a view that actually financial professionals really don't have the skills to be able to interpret the data properly. So actually we could have a lot of decisions being made, maybe not on the right basis in terms of the data. And then we have this rise in regulatory expectations, central banks and supervisors, but it's very much focused on climate risk and not net zero. Maybe that needs to change. So in light of this, we reflected as a group and came across, in a sense, these sort of principles to guide how the government and market participants, consumers of financial services and others might want to take forward. First is this recognition of the prize, that actually we can mobilize this net zero investment if we have the policies and market frameworks in place. So it's a measure of, it's a signal of confidence. The second is then the question of mindset. Need to shift really from the risks, a pure risk-based focus on climate change, very important, absolutely essential, but actually complement that with a focus on aligning with net zero, but also these other goals of resilience and just transition. Then we need to think about what needs to happen in the economy and the so-called real economy policies. We need to have those tightened and strengthened to actually act as a pull, as an attractor for investment, so carbon pricing and other sector regulations particularly important. But also, number four, we need to think about what happens in the financial system itself. And again, I think here we're talking about a shift in terms of financial policy and regulations really needs to be designed with net zero in mind. And finally, the world. We are in a situation of open capital markets, and successful net zero financing will depend on effective international financial architecture. And the UK can play a role in co-creating that. So those are the very high level principles we set. And I just want to go through 5 sets of slides setting out what that means in practice. And then it will be back to you in terms of your questions and comments. So the first is a set of strategic recommendations, really for the UK government, the Prime Minister, the Chancellor, and again, in other countries, to the President or the Finance Minister or whatever. Firstly, we really need to have a commitment for the UK to be a net zero financial system, alongside being a net zero economy, and the UK could be the first in terms of setting that target, and then this would be cascaded down through market practice, regulation, and public finance. We do need to focus on the investability, the bankability of net zero projects, improving the predictability, and do that through very, very clear sector by sector transition pathways, carbon pricing, and also de-risking mechanisms. And third, we'll need to design these net zero policies to ensure that they're fair, this whole issue of the just transition, that they're connected with resilience, and enable local financing. And I think that's a big issue, particularly for financial centers, obviously hosted in the sort of the capital cities and the metropolis. How do they intermediate capital to the regions where the bulk of this investment is going to be happening? So that whole place-based financing dimension, really, really important. Then at the level of private finance, what can the private financial community do to take forward this agenda? First is to make sure that market innovation responds to the net zero imperative, really scaling up this idea of transition finance in terms of supporting and enabling companies and consumers to make the shift, thinking about new financial vehicles. We're starting to see in the UK some interesting crowd-funded municipal bonds, and again, thinking about very tailored sector financing tools, for example, in the housing sector with green mortgages. Then we will need to build up the skills and capacity of, again, the UK's financial professionals. 1.1 million or so in the UK. All of those need to have the capacity and the competence to advise and support their clients through this process. Some good things to build on, such as the Green Finance Education Charter. And again, on the other side, when we talk about net zero finance, green finance, we often talk about the suppliers of finance, and perhaps not enough about the users and the consumers of finance, and really the importance of building up the literacy, the expertise, and the confidence of the users of financial services to demand climate-aligned products. That will require boosting financial literacy, which is often poor, through more transparent products as a key area. So that's key for the private finance sector. Then in terms of financial regulation, again, building on this work and the momentum from central banks and supervisors, and here are sort of four key areas that the advisory group highlighted. First, to continue work on climate risk, but really to integrate net zero as a target into financial regulation and monetary policy, prudential work, but also to ensure that sort of monetary policy tools, such as collateral frameworks, refinancing, and asset purchases, are aligned with this net zero goal. And I think that's a really critical role, particularly at the time of the COVID crisis and the large scale of central bank liquidity provision at the moment. Second is then to build on the innovation we're seeing from leaders in the financial sector in terms of setting their own voluntary plans. And I think the role of financial regulation is often to universalize good practice, so making net zero plans and targets mandatory for financial institutions to show how investors and banks are going to make their portfolios consistent. Third point, an interesting one, is much of the capital, particularly in the corporate sector, that is needed for this is already residing on balance sheets, retained earnings, and therefore investor stewardship is really important to incorporate the achievement of net zero in the use and deployment of that capital. And finally, obviously, anything in this area needs clear metrics. The EU has led with its sustainable finance and taxonomy, and the UK has just announced its green finance taxonomy, which will be very closely aligned with the EU model. And that is key, so we're all talking the same language about what we mean about net zero. Then public finance. Clearly, private finance can do a lot on its own. Private finance can do a lot with supporting regulation. But a lot of what is going to be needed, particularly in terms of early stage of markets, is going to require public finance, and particularly at this moment of crisis in terms of COVID. So real priority in making sure that the COVID recovery plans in the UK and every other country fast-track climate investment. The UK has been scaling up this, still a work in progress, but ambition is increasing. And importantly, green sovereign bonds, I think, have a major role to act as a financing mechanism for these recovery plans. And again, the UK will be issuing its first green sovereign bond this year. Many others have been doing that already, and I see this is a big sort of shift that could be underway this year. So that's the sort of recovery plans. Then, obviously, there are dedicated public finance institutions, and we need to make sure that net zero and sustainability is embedded into the purpose and mandates of these. In the UK, we have a SME-focused organisation, Development Bank, the British Business Bank, and then externally, the UK Export Finance Bank also needs to have all its financing linked to net zero. There has been some controversy about continuing financing of fossil fuels, which has now been closed. One of the consequences of the UK's exit from the European Union is no longer having access to European Investment Bank, and a new national infrastructure bank will be established, and it has been situated in the context of the country's climate goals, and very important that this new national infrastructure bank has a net zero and sustainability mandate, particularly to respond to that question of local delivery and regional delivery that I mentioned as a weakness at the moment, or an obstacle, and then obviously crowding in private capital behind it. And then I think this is my final slide, particularly in terms of the international framework. I started off, and many of you will be focusing on this COP26 summit, which will be hosted by the UK in November in Glasgow. A really important point to translate net zero and resilience and just transition into a real workable architecture. And so the recommendations from the group to the UK government about really building the international frameworks to accelerate financing in net zero at COP26, but the UK is also president of the G7 group this year, so another major opportunity. And three ideas here: bringing together a coalition of countries committed to net zero, financial reform along the lines that we've laid out. I think there's a real opportunity to mobilize finance in many different countries through coordinated issuance of green sovereign bonds. We have, I think, over 10, 11, 12 now countries committed. The UK will issue this year, Spain will issue this year, Italy will issue this year, but a coordinated issuance would send a really powerful signal to global capital markets. And then there's a role, I think, in terms of filling a gap in the architecture at the international level, proposed international platform for climate finance, maybe a little bit akin to the International Panel on Climate Change on the science side. And this would really help to bridge the global financing gap, particularly for emerging economies, where the bulk of this capital is going to be required. I think I've got one more slide, which is really just further reading. I have necessarily have to go very quickly, but I think this slide deck will be made available to you. Just here are a set of further reading for you, which will go into more detail on the Road to Net Zero Finance Report itself, the work we've done on central banks, the design of a green plus sovereign bond for the UK, and then the work we've been doing on just transition. So thanks for listening, and Simon, back to you for the discussion.
Wonderful. Thank you very much, Nick. I'm going to take the chairman's privilege to ask you the first question. We have an absolutely enormous number of questions. I am going to consolidate and summarize a lot of these. So I do apologize if I don't get round to you precisely, but as I mentioned, you can contact Nick directly to continue this discussion offline. My opener for 10 is, you actually mentioned a lack of policy clarity from the UK. I note that recently there's been a decision to grant permission to open the West Cumbria mining project to extract coking coal from beneath the North Sea. How confident are you that the UK government is actually serious in its ambitions for climate change and net zero?
Thank you. And then we've actually, thanks to all of you who've actually responded to the poll. Maybe I'll come to that and then come back to this particular decision. So I think it's quite interesting results. Do you have confidence that the financial system will be able to mobilize the required investments? I think 26% saying yes, 68% saying moderate confidence, which I think is a good place to be. I'd be in that position. So I think that's clearly the mood of the meeting. And then 6 not confident at all. So the bears out, the sort of net zero bears out there on that. So I think the case you mentioned is an interesting one. I suppose 2 comments. Firstly, I've seen in the last year, and I think this is a consequence of COVID, is that net zero is no longer seen, I think, as a environmental burden, but as a driver of growth, innovation, and jobs. And the UK Treasury has certainly issued that in their recent net zero paper. So I think that's very much the aspiration. I think probably what we're doing is we haven't yet realized how this has to be applied in a comprehensive fashion. And so we have a sort of net zero target in law for the UK, but that hasn't yet been cascaded down through all the decision frameworks. And so we do have a decision where, at a local level, this local authority looking to create jobs in a very impoverished region of the UK has approved, on local considerations, a coal mine. And their argument is, well, we only have a mandate to think about local consequences. So you can see a disconnect there. That we have a national level target, net zero, and I think the government is serious about this, but we haven't yet seen these interconnecting policies to cascade down that, so that local authorities do make decisions like that with net zero in mind. I find the decision very troubling, because actually I think that this could further weaken that region's economy. It is a relatively poor region. That is a region where there is previously a major nuclear facility which is closing down, and although this coal is going to be used for steel and not for coal and so on, there are great steps in the steel sector to move away from coal entirely. So my fear is that there'll be a lot of investment, both financial and also sort of human capital investment, in an asset that will be stranded, and so actually will be worsening the situation. So it's a case where, again, I think perhaps at a local level, to develop a clear sort of green recovery plan, which is very clear about benefits for local enterprise and in terms of jobs and so on.
So yes, invest in the great white hope rather than the great white elephant, I think, is the moral there. Now we've got several questions on a similar theme, which is around the financial sustainability of net zero investments. Ultimately, companies who are managing funds for people have a duty to turn a profit. Are net zero and profitability mutually exclusive, or can you actually see net zero projects having an advantage?
So, I mean, this is a long-standing issue. I mean, I think a number of things. Firstly, I suppose good investment is about anticipating future conditions, and particularly if you're an active investor. But even if you're in passive investments, clearly the price of those assets should be thinking about discounted cash flows into the future. So my sense is that getting to a net zero world is now inevitable. Technologically, it's inevitable. Electric vehicles, renewables, and so on. The question really is one of timing. And I think how quickly we get to that, and how quickly we stave off catastrophic climate change. That might be seen to be too bold, but my sense, I'm fairly confident we'll get there. It's really a question of timing. So I think particularly for long-term investors, pension funds, insurers, I think there's a very strong case about aligning your portfolios with long-term investment trends. Clearly, that is not going to be a smooth path. I think we have already seen signals in terms of, let's say, the oil and gas sector, and I mentioned the Dong BP shift. And I think we have seen investors who have been able to move outside of conventional benchmarks and not being shackled to benchmarks, getting out of fossil fuels. Actually, they've been able to actually protect their clients' money in a quite substantial way. So I think actually the key to good investment obviously is anticipation, but also not to be too far ahead of the market. I think on the other side there is an issue potentially of green bubbles. Yes, bubbles in asset prices. Particularly as you do now have this surge in awareness, and there is, I think it's fair to say, a shortage of authentic ESG assets to invest in, and so you are
There's
seeing.
definitely a pipeline issue, isn't there?
huge pipeline issue. And so I think that does create a problem, and potentially, therefore, I think you may have a lot of people wanting to invest in, let's say, new net zero investments, maybe particularly at the project level, but actually because of the oversupply of demand, the pricing simply isn't attractive. So again, I think where you have those sort of market imperfections, that is where investors, I think, together can really make a clear case to government. It's really only really for government who can help unblock some of those areas. So a lot of work, I think, on the policy frameworks, particularly on that, because we don't want to see unintended bubbles being developed, and then obviously I think a lot of good intentions being suffering as a result of those bubbles starts to implode. So I think that is a concern. I think particularly at this stage is actually therefore to build that asset pipeline, as you were saying, Simon, so that actually you can have that orderly reallocation.
I've got several questions on a similar theme here, which are around a leadership position for the UK. How valid is the UK's stance on this? How can we take a leadership position when we have offshored the majority of our emissions? And can the UK, even if the UK financial sector did go for net zero, what impact would that have? What difference would we make?
Yeah, no, I think it's a really interesting point. I mean, clearly, Zian, you've been doing your sort of Green Financial Centres Index, and as I mentioned at the beginning, when I was at the UN, set up the Financial Centres for Sustainability Index. So you're seeing lots of sort of rivalry and sometimes claims about we're the centre of green finance or we're the whatever. So I think London has a lot of strengths. But I'm certainly, I mean, it's clear that many other financial centres are really making striking gains, and I would say are in the vanguard and in the leadership position. I think Paris has really grown substantially in its work, and I think obviously we'll wait to see how the US financial centres gear up now that there's going to be a new administration. So I think on the question of sort of, as you say, the UK has, in a sense, reduced its industrial emissions, offshore some of those. I think one of the big challenges for the UK financial system is it's always been much happier financing international capital projects than actually financing the UK hinterland, let's say. So I think this will be a refocusing for some of the UK financial institutions on the UK. I think potentially for the banks, with the sort of post-crisis restructuring and the ring fencing, that mindset becomes easier because the banks in the UK are going to succeed to the extent that net zero succeeds. They're going to need to see this financing be successful and the transition being successful. They don't want to see stranded assets up and down the country. So I think that is a challenge, I think, particularly for the UK, is that we have a very global financial centre, and actually how that then serves, let's say, the hinterland. And I would think in the context of this year, there is a potential for the UK to lead, not least because of the hosting of COP26, but also to recognise where it can learn from others. So clearly, it is a follower in terms of green sovereign bonds. And we've proposed the government could innovate by having what we're calling a green plus. So you have green use of proceeds plus social co-benefits, particularly relevant in COVID. So again, it's a follower, but I think could take a leadership role in that sort of coordination, perhaps, of a green sovereign bond issuer club, let's say. And then there's lots to learn, obviously, in terms of National Infrastructure Bank. The UK doesn't have a really long tradition at all in terms of domestic public finance, and so lots to learn from Germany, the KfW, from the European Investment Bank, and many others. So I think sort of taking a very balanced approach, lead in some, sort of follow others, and learn a lot in terms of other areas as well.
Yes, and I suppose if we do set up a domestic bank, it really shouldn't follow the rather sad route of the green investment bank, which is probably not green or an investment bank anymore.
Well, it was maybe on that. I mean, the Green Investment Bank was neither one thing or another. It wasn't really a private sector investment fund nor a proper public sector funds. So I think it fell between those two priorities. Yeah, sorry, Simon, back to you.
Right, I've also got several similar questions in the same vein, which are talking about how net zero and socially responsible investment are not necessarily the same thing. How do we
Mm-hmm.
ensure that in taking a net zero approach, we continue to consider the broader environmental, social and governance issues?
No, really, really good point. And I think obviously, I think there sometimes is conflation in people's mind between ESG and climate. I can remember seeing actually one person who really should know better saying, oh, well, because we got all these flows of funds into ESG funds, it's going to be no problem raising money for climate investment. Two quite different things, two really quite different things. And again, although this presentation has been about net zero and it is a priority, this does need to be put in the context of that broader ESG or sustainable finance agenda. I've mentioned in particular the just transition. So this is ensuring that as you make these net zero investments and this shift, that people aren't left behind and don't have regions being left behind. And we know the consequences of that, both in the human sense, but also in a political economy sense. So that sort of, I suppose, linking the E and the S, very important priority, and then actually going beyond net zero to the broader environmental agenda. And I think one of the things we've seen with COVID is it's really highlighted the sort of the real systemic materiality of resilient nature. That we know that COVID is a zoonotic disease. It comes from a disruption of natural systems. And previously, the price economists were putting on nature was pitifully small. But if you look at one of the triggers for COVID being the degradation of natural systems and the loss of biodiversity, it tells you that actually this is truly systemic in terms of consequences. So I think linking net zero, the climate, and the nature agenda, and then obviously putting that in the context of broader social responsibility on the S of ESG, absolutely important. So very good point.
Now, I have a number of questions around the effectiveness of voluntary
Mm-hmm.
schemes, particularly for reporting and disclosure. Um, Membership of the PRI is very widespread, but the PRI principles don't seem terribly aspirational. What more can be done to raise the game with regards to voluntary schemes?
Yeah, no, I mean, I suppose there's a broader comment. I mean, I think voluntary initiatives are very important because I think they encourage experimentation, particularly by individual organizations, enables institutions to respond to the priorities of their clients. And I think what you see is potentially a dynamic between sort of voluntary innovation and testing and market testing, and then regulatory adoption once it's got to a certain scale, and then mainstreaming it through making things mandatory. I think we're seeing that through the TCFD, which started off as a market-based, market-driven initiative, and now will become mandatory in the UK in the coming years and in other countries as well. So I think there is that dynamic between sort of market being very good at experimentation, leadership, but then actually once something is established and robust, then the purpose of regulation is really to drive that forward. I think in terms of the PRI, I think they have been upping their standards. So TCFD reporting in consistency with TCFD is now a priority in our requirements. And interestingly, human rights will be as well in the future. So responding to the previous question that was mentioned in terms of the S. One piece of research that is worth checking out. Very interesting research actually coming out of France because they had mandatory reporting, Article 172 after the Paris Agreement, mandatory reporting about climate change. And actually very interesting academic analysis showing that this has had a real material impact in terms of the content of portfolios. So I would think that again, mandatory nature, obviously something which isn't burdensome in terms of regulation, but actually can have real movement in terms of the reallocation of capital we need to see.
Fantastic. Nick, I am conscious that we are rapidly running out of time. I really meant to ask you about the EU ETS and what was going to happen for carbon trading in the UK in the future, but we simply haven't got time to discuss that at the moment. I know that some of you have still got questions. Please do contact Nick offline to continue the discussion. We're going to be posting this presentation, all the slides, within the next couple of days, so you can revisit this. It just remains for me to thank the members of the FS Club for making today possible. I'd also urge you to keep an eye on our forthcoming events, and I'd like to put in a particular plug for an event we're holding on the 1st of February, where you can listen to the Right Honourable the Lord Mayor, Alderman William Russell, and a panel of experts, including Mark Carney, Liv Garfield, and Ryan Murray Thomas, discussing building back better, the city's role in a green-led economic recovery. Until we meet again, please do stay safe. Nick, thank you very much for a fascinating presentation. I wish we had more time. Thank you all, everyone, and goodbye.
Thanks, everyone. Thanks, Simon. Thanks, Morgan.